What is beneficial ownership under federal law? The entity is not enough. The human behind it matters. Up to this point, you have learned about covered residential property, covered legal entities, and financing triggers. Now we arrive at the heart of the 2026 Real Estate Reporting Rule, beneficial ownership. The rule is not concerned with the name of the LLC. It is not concerned with how professional the articles of organization look. It is not concerned with how many properties the entity owns. It is concerned with the real human being behind the entity. That person is called the beneficial owner. Under federal transparency laws, including the Corporate Transparency Act, 31 U.S.C. paragraph 5336, a beneficial owner is generally defined as an individual who owns or controls at least 25% of the ownership interests of the entity, or exercises substantial control over the entity. The key word is individual, not another LLC, not a trust as a standalone label, not a holding company, a real human being. Ownership versus control. Beneficial ownership can exist through ownership percentage or through control. Both pathways matter. The first pathway is ownership interest. If an individual directly or indirectly owns 25% or more of the entity, that person typically qualifies as a beneficial owner. Consider this Arizona example. 4 investors form Sunrise Rentals LLC. Each owns 25%. All 4 individuals may qualify as beneficial owners because each meets the 25% threshold. Now consider a different structure. 1 investor owns 70% and 3 others own 10% each. The 70% owner clearly qualifies. The 10% owners may not qualify under the ownership threshold alone. However, ownership percentage is not the end of the analysis. The second pathway is substantial control. An individual may qualify as a beneficial owner even if they own less than 25% of the entity, provided they exercise significant authority or influence. Substantial control may include authority to make major business decisions, power to appoint or remove managers, control over financial accounts, or significant influence over the direction of the business. Imagine an Arizona LLC with 3 passive investors and 1 managing member who owns only 10% but makes all operational decisions. That managing member may qualify as a beneficial owner because control, not just ownership percentage, defines the standard. Ownership percentage is measurable. Control is functional. Both count. Layered and indirect ownership. The rule does not stop at direct ownership. It also looks at indirect ownership through layered structures. For example, LLC A owns 100% of LLC B. LLC B purchases residential real estate. LLC A is owned by 2 individuals, each holding 50%. Reporting does not stop at LLC B. It traces upward to the individuals who ultimately own LLC A. The purpose is to prevent layered entity structures designed to conceal identity. Arizona frequently sees holding companies owning multiple single-purpose LLCs, separate LLCs for each rental property, parent subsidiary structures, family LLCs, and trust-controlled LLCs. Before 2026, many agents never needed to ask who ultimately owned the purchasing entity. Beginning in 2026, understanding that structure becomes central to transaction awareness. Why this matters in Arizona. Investor markets. Arizona's investor culture makes beneficial ownership especially relevant. Rental portfolios are often held in separate LLCs. Short-term rental operators frequently create property-specific entities. Real estate investors commonly use parent holding companies. Agents are not required to investigate ownership structures. However, they must understand that federal reporting looks beyond the entity name to the human behind it. Understanding beneficial ownership helps agents anticipate client concerns, coordinate effectively with escrow, maintain credibility with sophisticated investors, and avoid appearing uninformed when transparency questions arise. The purpose behind beneficial ownership. Reporting. The purpose of beneficial ownership reporting is not to prohibit investment. It is not to eliminate LLC use. It is not to interfere with legitimate asset protection planning. The objective is transparency. Federal regulators aim to prevent anonymous ownership structures used to conceal illicit funds, evade sanctions, integrate fraud proceeds, or facilitate organized financial crime. Transparency does not eliminate structure. It identifies the human being behind it. Arizona legal context and federal overlay. Under ARS Title 29, Arizona law governs the formation and operation of LLCs. Historically, Arizona did not require public disclosure of all members in the same way federal reporting now requires disclosure to FinCEN. That distinction created privacy advantages at the state level. However, state formation privacy does not override federal transparency requirements. Federal law operates alongside state entity law. For Arizona agents working with sophisticated investors, this distinction is critical. The existence of a properly formed Arizona LLC does not eliminate federal beneficial ownership reporting obligations. Transition to Section 3.2. Now that you understand who qualifies as a beneficial owner, the next question becomes more practical and more sensitive. What specific information must be collected and reported? This is where investor discomfort may surface. This is where professionalism and neutrality matter most. FinCEN 3.2 will address the specific data elements involved in beneficial ownership information reporting and how agents should professionally navigate those conversations.